Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 28th of February. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about how investors should be more selective in US equities and go for large cap quality stocks. For European stocks, we believe investors should also be zooming into specific sectors instead of getting broad-brushed exposure for the short term. First of all, there's growth risk. Now, European equities tend to bottom when PMIs trough. Their performance since October last year has been in line with prior occasions when PMI started to recover post a recession. However, beyond the sentiment surveys, we would need to see recovery in hard data as well. So in Germany, for example, we're yet to see the data decisively showing an upward trajectory. Thus, European equities may be susceptible to a pullback in the near term. Next, the ECB may be a little bit too reactive rather than proactive. So the central bank has been focusing much on wages, even though wages may be lagging inflation rather than leading it. Recent data suggests that wages are rolling over and conditions are building up for ECB rate cut, but that is not really showing in ECB's communications. So there's policy risk, and we need to see the ECB prioritizing growth over any lingering inflation fears. Arguably, however, the biggest short-term risk for European equities is the stretch positioning, particularly from managed future strategies that are sitting on extended long positions in DM equities. So that means a positioning-led sell-off in the US could spill over to the other momentum assets, such as European equities. So for investors in European equities, they may focus upon the healthcare sector, which is relatively more defensive and have light positioning. Now, in an environment where investors are looking for uncorrelated themes, momentum behind stocks related to diabetes or weight loss drugs could benefit. Another sector that is looking interesting is the European luxury sector. Now, that contains companies that are larger in size and quality in style. Both of these factors have been more resilient in prior environments when the positioning-led sell-off had taken place. Moreover, the China factor is potentially a strong upside risk given the recent intensity of stimulus from the Chinese government. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.